Welcome to Breakthrough Success. I am your host, Marc Guberti, founder of the Content Marketing Plaza, bringing you 3 new episodes each week where I and top-level guests teach you how to take your business to the next level and achieve your breakthrough. And before we jump into today's episode, let me ask you a quick question. How much would your life change if you could make 6 figures from your content? Imagine being able to quit your 9-to-5 job, do what you love for a living, and spend more time with your family. That's what we help our students do at the Content Marketing Plaza, an 8-week program that will help you build your way to 6 figures via your content. You can learn more about the Plaza by heading over to contentmarketingplaza.com, which will be in the show notes. All right, let's jump right back into the episode. When we make money, we have to think about what we are going to do with that money. And this is where we get this idea of multiple streams of income. It's also where we get this idea of investing. And one of the ways we can invest is in real estate. And self-storage is actually presenting itself as a recession-resistant asset class, which today's guest, he's an expert on this area of investing. We're going to go right into this really soon, but just to give you an idea of who exactly we're talking to. He is a full-time real estate investor and founder of Cash Flow Connections, a private equity firm based out of Los Angeles, California. Since starting Cash Flow Connections, he has helped more than 200 investors allocate capital to over 100 properties, which has a combined asset value of over $350 million. He is also the author of Little Boxes, Big Profits, a passive investor's guide to self-storage, and he hosts the Cash Flow Connections Real Estate Podcast, which helps investors learn the intricacies of commercial real estate from the comfort of their home, car, or office. Today's guest for episode 313 of the Breakthrough Success Podcast is none other than Hunter Thompson. Hunter, it is such a pleasure to have you on the show.
Hey, thanks again for having me on, Marc. Honored to be on.
Hunter, it is such a pleasure to have you on the Breakthrough Success Podcast. So much to talk about in this episode, and real estate is such a great place to invest if you do your due diligence, if you have the insights. So that's what we're going to help you a little bit with in this episode. Before we get into all that, though, I'm wondering, Hunter, if you could share a little bit about why you started Cash Flow Connections and how that began.
Yeah, sure. So most people, when they talk about real estate, kind of the way that story starts or ends has something to do with 2008. Mm-hmm. And for me, I was one of the very fortunate people that didn't lose my shirt. I wasn't really involved in financial assets in 2008. So when that happened, I was still finishing up college at the time, and I realized there was going to be an opportunity there. I saw that the old adage of investing when blood is in the streets, there couldn't be a more perfect example of that going on. And so that was really my entrance into the financial markets. And this was really my focus, equities and stocks and bonds and mutual funds, just investing similar to Warren Buffett, finding value stocks and holding them for the long term. And I had some success in this. Of course, most people did if they started at that time. But it wasn't until 2010 that I really started becoming more and more interested in real estate. I mean, the first thing is, when you talk about investing, most investors, if you really whittle them down to get to the basics of what they're trying to accomplish, most of them are looking for predictability of outcome and cash flow to pay off their expenses. The challenge is that the stock market is a very indirect route to accomplish those goals. And as I was kind of pondering this thought and really realizing that you had to have a massive portfolio to be able to achieve retirement through stocks, something really interesting happened that very many people don't talk about, which is the European debt crisis. And this was basically Europe experienced something very similar to what the United States experienced in 2008, but it was in the European central banks. They were freezing up. There was a lack of liquidity in the markets. It was causing crazy volatility, not only in the European markets, but in the U.S. markets as well. And I remember I was watching CNBC, and the anchors were talking about the Greece bond yields. And they were saying if the 10-year yields stayed below 7%, that the S&P 500 was going to be fine. And if the 10-year went above 7%, the S&P 500 was going to collapse. And I just remember thinking, how is it possible that the greased bond yields are playing any role, let alone a significant role in my financial well-being, to the point where everyone on CNBC is talking about this. It's absolutely ridiculous. How could I have predicted that? How could I have mitigated that risk? And by the way, for those of you that don't know, it did go above 7%. It went above 25% and then above 35%. It was just causing absolute mayhem. And that was really my last straw moment, which eventually led me down the real estate route. And once I really fell in love with the vehicle, and created a company to help people invest similarly.
And that is a very interesting story. I mean, real estate's a little more predictable. It's a little more, once you have the systems in place, like the cash flow is coming. I'm wondering if we could briefly talk about the difference between investing in actual real estate and a real estate investment trust, and your thoughts on that.
Yeah, so actually that's a really good, important part of this question, because as you start to get into the real estate world, you realize that there's basically two approaches to investing. One is an active approach in which you are the owner of the properties. You directly interact with the property manager. You're the overseer. You decide when the properties are bought and sold and how much to raise rents, etc. And the other approach is the passive approach. And so most people, when they enter the real estate market, they're most familiar with the active approach. They think, oh, if I put up this $50,000, we can get a loan and I can buy a $200,000 house or something like that. That's common, but the challenge with that is that you're leaving a little bit of opportunity on the table, because there's not that big of a difference of someone that has an absolute expertise in owning single-family houses and someone that owns one or two single-family houses. And the reason for that is exactly why most people invest in it, because it's a low barrier to entry. It's a relatively simple asset class, which is one of the benefits of it, but it doesn't lead for this massive discrepancy in terms of a discrepancy between a best-in-class and a mom and pop. So as I continue this route in real estate, I realized that there was commercial real estate assets that are very complicated. Now, they're still simple enough for you to accurately predict the outcome, but complicated enough so that if you have 20, let's say self-storage facilities, for example, which you mentioned earlier, there's so many complexities that go along with the asset class, such as, relationships with U-Haul, relationships with nearby businesses, the ability to scale the business, merchandise sales, and getting margin on that merchandise sales because you're buying a bunch of them. And the economics of it just is much more favorable if you have 20 facilities as opposed to having one or two. And so when you get into those really complicated asset classes, then it's a really good opportunity to defer to someone else's expertise, because their expertise is much more lucrative. And so that's really where I find myself in the real estate sector. I like to be on the passive side of things. I identify best-in-class operators. So, for example, people that only invest in mobile home parks, people that only invest in self-storage or only invest in retail. They spend their entire life focusing exclusively on retail. They get all the relationships. They know the leasing agents. They know the markets. They have the brokers. And then as a company, we invest capital with those firms. And because of this, we're able to be hyper diversified across the country and across a variety of different asset classes. So to answer your question directly, real estate investment trust is a formal structure where people pool their investors together and invest in properties passively. We, technically speaking, we don't use that term because it's not exactly how our company is set up. But from a layman's approach, it's basically the same thing functionally, where we pool investors together and we purchase a passive interest in these, $15 to $50 million commercial properties.
Now, I've heard, I feel like a lot of people, when they hear about real estate investing, they think single family, as you mentioned before. They also think multifamily. But self-storage, that may not necessarily be the first place people think of right away when it comes to real estate. I wonder if you can just give us an idea of why self-storage is something that we should consider. I know I mentioned earlier that it's recession resistant. I'm wondering if you could talk a little bit why that's the case and just a little bit more about the self-storage.
Yeah, sure. So first of all, I think, to your point, when looking at investments, it's good to look at the state of the economy to kind of pinpoint which investment vehicles are going to make sense. So before I even get into the specifics of self-storage, looking at the big picture, I'll say this. I studied economics in college, and I think anyone that did that probably realized, yeah, it's an interesting sector, but it's a very challenging to say. You can manipulate data extremely significantly to create whatever thesis you want. So I don't find big economic data that's extremely analyzed. It doesn't very compelling to me. However, there are some overwhelmingly large economic data points that I find are insurmountable and therefore are more challenging to be, swayed based on your bias. Okay, and I'll give you an example of them. Just one big picture. There's 10,000 baby boomers hitting the age of retirement every single year. Many of them have very little savings, and a lot of them are relying on Social Security as a source of income. The challenge with that, though, is that the average Social Security check is about $1,200 a month, and the average two-bedroom apartment rents for about $1,300 a month. So you have the situation where there's going to be a lot of downsizing in the economy as a whole. Now, that paints a really positive data point for self-storage because you see that when people downsize, it's one of the main reasons that people use the product. They're going from a 4-bedroom house to a 2-bedroom house, but they don't want to lose their stuff, so they move their stuff into a self-storage facility, and then they have that smaller living facility. You also have things like the wage earners in the United States. 51% of the wage earners in the United States are making less than $30,000 a year. So you have a lot of these negative economic data points that are really strong in terms of investing in assets that are recession resistant. And so this is one of the reasons why I like the self-storage model. Now, with self-storage, as far as why it actually is recession resistant, well, the first reason is that people use the product when they're going through some kind of lifestyle change. So you think about people going through some kind of job change or foreclosure or getting laid off or downsizing or having their kids move home from college unexpectedly. And 50% of college graduates move back in with their parents right now for a certain amount of period of time, a short amount of period of time, but still nonetheless it's taking place. So those are exactly the reasons why people use self-storage, and all of them are more common during recessions. And you also have things like the fact that it's a gross dollars perspective. It's an inexpensive way to store things. You're talking about renting a facility that's $100 a month, $150 a month. So that doesn't, when you're raising rents in a property like that, you can raise rents pretty aggressively, and the tenant base is not as price sensitive because it's not that significant to them on a gross dollars perspective. So if you raise rents from $150 a month to $159 a month, it's only $9 a month to the tenant base. The question is, are they really going to take the day off work and hire movers and get a rental truck and move down the road where they're probably going to do the same thing just for $9 a month? Probably not. But as an investor, that's a 6% rental increase. That's very, very significant, especially over the long term. So those are some of the reasons that I like the asset class, and also just tremendous ways to add value. But in terms of recession resistance, that thesis that I just kind of outlined is very well backed up by the historical data. Both in 2001 and 2008, rental rates were actually stabilized or increasing during those recessions. And so it's always good to check, your big picture thesis with the data points. And I think that those line up very well.
And for something like a self-storage, and this could apply to any real estate property, what is the approach to getting tenants? Because I think one of the big fears people have when they make one of these kinds of investments is that they're paying this extra money, but if they don't get the tenant, they still got to eat the mortgage and the property tax. So I wonder if you could talk a little bit about getting tenants.
Yeah, I mean, really what you're alluding to is the whole supply-demand disequilibrium. Can you identify a market where there is adequate demand for your product? And then even to go one level deeper, there's a metric that's frequently talked about in apartments, for example, which is the cost to build. And basically people use this metric to say, if I can prove to you that we're buying at this property at a rate that's lower than the cost to build, it's a good deal. Well, you don't hear that metric at all in self-storage. And I'm kind of revealing the secrets of the trade, but the truth is it's easy to build these. So what's even more concerning, again, to address your question about tenants, you have to be in a market where it is either there's a big barrier to entry to build new self-storage facilities, or there's a really significant and favorable disequilibrium in terms of supply and demand. And so we analyze markets. I mean, a rule of thumb that we use, the average across the United States is about 7.7 square foot of self-storage per person in the United States, and that's also pretty market specific. So what you can do is you can find an area, a market, like with a 5 mile radius, and get the population of that 5 mile radius, and then get the number of square feet in that 5 mile radius. And that will give you a really good understanding. If the ratio is higher than 7.7 square foot per person, then the market is oversupplied. Now, if it's only 3.3 square foot per person, then the market is undersupplied. And so you can play with those metrics and try to identify markets where there's a lot of demand for the product and there's not enough self-storage square footage. If you invest in properties that are like that, or markets that are like that, even if someone develops a property next door, you still are able to raise rents aggressively and increase occupancies. So that's the best way to address that. But it's a big concern in the industry because you can develop them very quickly. And so you have to be very cautious about the markets you invest in.
And it's interesting you give us that metric because, I mean, just doing that research makes it clear like which market can really give you the most opportunity based on if you have an oversupply or an undersupply. If you have less competition there, it makes more sense to set up a property there, buy an existing property. And I mean, it's great for recession, and I understand it because people are looking to downsize and they don't want to lose their stuff. But going a little bit more into the portfolio, like the whole picture. I mean, I mentioned earlier the 350 million in property asset value. I'm wondering, how do you go about balancing everything from a self-storage to a multifamily to some of the other areas that you invest in where they're on different parts of the economic cycle?
Yeah, that's actually a really critical question right now, especially. And it's a good question because it's something that most people aren't taking seriously enough. Now, in all fairness, part of the reason they're not taking it seriously is that a lot of people either focus exclusively on one asset class or they're active investors, meaning that they feel that they have to have a market advantage. And the only way that they can have a market advantage is only focusing on, just apartments, for example, just in Texas, something that's very common right now. The challenge, I would say, is that, when it all comes down to it, I mentioned earlier the predictability of outcome and the cash flow to pay off expenses. That is all fine and well. But the truth is, the reason I'm in this game is because I want to be able to sleep at night knowing I'm well protected. And the way I do that is through that predictability of outcome, et cetera. So I have taken the passive approach and therefore leverage relationships with institutional quality sponsors of those asset classes so that I can achieve that true diversification. And so in terms of building a portfolio right now, I'm a huge proponent of multifamily. We invested significantly in multifamily in 2011, but then we sold a lot of that multifamily in 2014, 2015, because we thought and still think that multifamily is extremely competitive and is overheated in a lot of markets. And so, when you're looking at it from a portfolio building perspective, you start to notice that because there's a lot of competition in the multifamily sector, yes, you do have the ability to get more loans. Yes, you're very likely going to be able to sell a property in a pinch because there's so many investors in the sector. But it doesn't allow you to be as lucrative or even get as favorable deals because of the competition. So in the mobile home park business, for example, right now, a lot more people are investing in mobile home parks than they were in 2011, 2012 when we were getting started. But in 2012, I would talk about mobile home parks. People think that I was absolutely insane, but I think it's great to have a mix of not only different asset classes, but asset classes that cater to different groups of the economy. Because if something weird happens where, the low incomes, all of a sudden there starts to be some kind of really some serious outsourcing or some automation where a lot of the low incomes, everyone moves down a rung so that everyone's making that $50,000 a year is now making $30,000 a year. If you're in the mobile home park business, that's going to be very advantageous for you. Now, you don't want to have your whole portfolio set up like that, and you want to be cautious about geographic locations as well. So you can see that no matter really what happens in the economy, even if there's some regulatory challenge, let's say, for example, that people say, well, self-storage is a scam. You can only raise rents by 3% per year if you're having a self-storage property right now. We're going to start treating self-storage as if it's similar to having, rental ceilings, or we're going to treat the self-storage tenants as if it's their home kind of thing. Well, that would be not good for the self-storage business. So you don't want to be over-allocated to any of these asset classes or any of these sponsors. So when it comes to building a portfolio, I like to be hyper diversified, and I would make the argument that I do have a significant market advantage over the competition because my advantage is being able to identify these on-site managers, the people that are operating partners, and that's really how we're positioned as a company.
And it's interesting you mentioned having different assets that cater to these different economic classes because, I mean, if you go all in on any area, I mean, I know we're talking about self-storage a lot, but if you go all in on this and then a big change happens, then that's really going to take a bite out of your entire income versus if you have these other assets in of different asset classes. I'm wondering if you can share a little bit about how we can calculate how much our monthly cash flow would be from a self-storage property. I know for a multifamily, you just charge a monthly rent. You get someone at that monthly rent. That is your cash flow. But how do you calculate that for self-storage where you have a lot of different tenants cover a certain amount of square feet?
Yeah, and so this is one of the benefits of the asset class is the different ways you can add value by increasing ancillary income. So yes, you do have things like the rental fee for actually renting the facility, but that's just a small fraction of what you can potentially do from a line item perspective. So we also have things like truck rental companies. I mentioned this earlier. So we have a pre-existing relationship with U-Haul so that when we buy a facility, we can buy a property based on in-place income, its current income. The next day, once we purchase the property, we call our contact at U-Haul and allow them to park up to 50 trucks on our facility. And then we rent out those trucks to the tenants when they're moving in and out, and we get a commission from U-Haul for facilitating the transaction. That one line item, I have seen deals where we invested in the property and they weren't doing something similar to this. And then 6 months later, there's an additional $3,800 per month in U-Haul commissions alone. Now, the key there is that $3,800 a month, real estate's traded on a multiple of income. So you're talking about $600,000 of value that you may have added. But when you're looking at things on a risk-adjusted basis, keep in mind, we didn't develop new units to bring in that income. We didn't actually even buy the trucks. We didn't maintain the trucks. Those trucks are owned by U-Haul. So my point there is that that's very favorable on a risk-adjusted basis. And so that's just one example. There's also mandatory tenant insurance. You can buy a property that isn't mandating that all the tenants have insurance on all their products, and then you implement that strategy. That can bring in an extra, let's say, $1,500 per month. Again, that could be in the range of another $250,000 of value added. So now you're getting up into the $850,000 of value added, upwards of $1 million of value added, depending on the market. And you're just simply implementing these strategies. Now, of course, there's other ways to add value. You can take a property that's mostly standard units and turn them into climate-controlled units, and you can increase merchandise sales or admin and late fees. All of these things really start to add up. And so it's not just about the rental income. The rental income is the most dependable, but there's all these other strategies that don't really require you take a proportional amount of risk to add upwards of $1 million of value to a property. So, and there's a lot of ways to calculate that, but I think that those are all reasonable numbers based on our historical track record.
And it's really interesting how it's not just the rent. It's, a lot of different factors can really come together to make this a profitable property. And I know
and just to add to that real quick, that was kind of what I was going back to at the beginning. As you see, there's so many ways to add value that there's also so many ways to do these things incorrectly and inefficiently. And so the business is about 77% mom and pop owners. So you think about all those line items I mentioned. When we look at our underwriting model, it's like 50 or 70 lines of different metrics that we keep track of. Each one of those lines can be done poorly. And so when we buy properties from people that are doing them very poorly, there's that huge discrepancy between a mom and pop owner and the type of partner that we want to work with. And that partnership allows for us to be in the passive role so that we don't have to be the ones that are implementing all the strategies. We can defer to their expertise. So sorry for interrupting. Just wanted to mention that because that kind of ties together there.
That is definitely another great point to think about how the property is set up if you're buying it from someone else. Because, with something like self-storage, you want to be very clear on the structure of that before you go into a property like that. And I mean, that's just part of due diligence. Earlier, Hunter mentioned the 7.7 square foot per person rule. I'm wondering if you could share a little bit more about what your due diligence process looks like going into self-storage, but also a property in general.
Yeah, so if I'm looking at the passive approach to investing, it's really about the operating partner. So my entire due diligence process is going through reading between the lines to ensure that the operating partner knows exactly what they're doing. Now, granted, because of how we're positioned in the company, we're kind of in a gray area. We take our due diligence process to a degree that passive investors would not be able to take, that it's economically unviable for them to fly and see every single property and things like that if you're just investing 25 or 50 or even $100,000. But, as a passive investor, what I really want to look at is, what is the track record of the operating partner? What is their background in the business? Can they pass a background check? I really want to look at who they are as a person. And so the way that I look at that is I look at their underwriting market, at the way that they look at each deal, and ask the question to myself, are they putting themselves in a position to deliver on their promises, or are they simply looking for this money to get this transaction closed, to get upfront fees, and then move on with their life? Because if you're investing in a real estate deal, these are illiquid investments, and a lot of them are going to be held for somewhere between 7 and 10 years. So the key is, do I want to do business with this person? Do I want to be in a partnership with this person in the technical sense of the word for the next 7 to 10 years? Do I want to be working with this individual? And so all of our due diligence is really about having hundreds and hundreds of questions, many times asking the same question twice, to confirm that the answers remain the same and to confirm that things are consistent and confirm that they're the type of person that's going to be conservative in their assumptions. Because you can market really high returns and get a lot of investors that don't know what they're doing. But the key is, once that deal goes wrong, that investor base is completely toast. They will not be investing with you again. This business can be very lucrative if you're able to deliver on your promises. And if you aren't, you're just wasting your time because it's not easy to attract accredited investors. So, I wrote an article about it. It was posted on Forbes. It's called 6 Due Diligence Questions Passive Investors Should Always Ask. If you just Google that and Google my name, you'll be able to pull up, some of my 6 favorite questions that if you're wanting to take the passive approach and you want to take it seriously, that's a really good starting place.
We will include the link to that Forbes article in the show notes, which will be markguberti.com/E313. It's interesting you mentioned all this due diligence you put in to basically make sure you're forming the right partnerships and building relationships with the right people. I mean, there's just so much detail that goes into any kind of investment. So with all this that goes on and all the different people who are either investing in real estate or they're thinking about it, I wonder if you could share with us, what do you believe holds most people back from being able to be successful real estate investors?
Well, unfortunately, I'd say that the main thing that's holding people back is an overwhelming marketing advantage that the large firms have to suggest at a very young age that all you have to do is get a job, invest in your 401k via stocks, bonds, and mutual funds, and when you're 59 and a half, you can retire. That is just simply not the reality of the economic situation that we live in, nor is that an advisable way to invest. I mean, you look at all the people that are significantly wealthy, the vast majority of them, number one, the vast majority of them created their wealth via real estate. Number two, overwhelmingly, they are all diversified outside of stocks, bonds, and mutual funds. And so, my point is, the main problem and the main reason that it's not as common is that it's very easy to allocate hundreds of millions and billions of dollars in the stock market. So if I raise $300 million fund, I can invest it tomorrow. I can just buy a bunch of Apple stock today, and that will be very, very easy for me to allocate that capital. So because of the fact that it's economically so scalable, now you have the ability to do a massive marketing campaign to teach everyone, including people that are very young, that that's the best way to invest. But it's just simply not the case. And so I have found that the reason most people haven't done this is that most people don't know that this is completely at their fingertips. There were some changes in some legal structures that took place in 2012 that really opened up this to the online community. So you can actually go online and find access to high quality real estate deals on the internet. and make the entire investment process online. Now, it's been a learning curve for people to learn how to go through due diligence online, but as millennials continue to increase their net worth, I think this is going to be something that continues to increase in popularity. And we're seeing it just, I've seen it in my own career, over the last 10 years, where people become very comfortable with people through things like podcasts and a lot of educational content that they put out, and they're willing to wire money to people that they met on the internet. 10 years ago, that sounded like a total scam. If you told someone you wired someone $100,000 because of some marketing campaign they did in a Google Ads campaign, they would think that you were absolutely insane. That's the reality of our business. We receive wires from people we've never spoken to on the phone before because of the infrastructure we built up and the reputation we have.
And it's interesting, like you mentioned, that how much things have changed just in 10 years, just in 5 years, and so much more can really change. And with all the change that's taking place, I mean, it comes down to who you are that determines whether you're going to be able to really leverage these big changes or not. And I think what really makes us who we are the habits that we develop throughout our lives. And with the habits in mind, Hunter, I'm wondering if you could share with us some of the habits you have right now that you believe have been essential to your success.
Yeah, sure. And I always like to kind of switch it up and talk about the entrepreneur side of things. It's something I'm extremely passionate about and something I love to talk about as well. I will say that the main thing that I wish I had understood, and every year that I understand this more and more, it becomes more and more effective, is if you are interested in pursuing something, especially something that's cognitively demanding, the combination of absolute speed of execution and focus is going to get you incredible results. So if you have a task that you're saying you want to learn a new task, real estate is obviously the thing that I've focused on. It can be extremely cognitively demanding. We're talking about using massive underwriting models in Excel and going through and learning terms that you've never heard before. The only way that I've found to be able to do this effectively is to block out a minimum, absolute minimum of an hour and a half, and usually a maximum, at least for me, about 3 hours. And so the first thing I do every morning is whatever the most important thing is that I need to get accomplished that's cognitively demanding. I usually work from 7:30 to 10 a.m. without answering emails or having my phone near me or even opening email, and just working on that singular cognitive demanding task. And if you do that every day for a quarter, you'll notice a fascinating difference in the scale and the growth rate of whatever you're trying to accomplish. This morning, I've mentioned that I've written an article for Forbes. That's what I focused on this morning. And so if I were to focus on just writing articles for Forbes every morning, that would be like an overwhelming accomplishment at the end of the year. Now, it's not my only goal for the year, but you can see where I'm going with that. If I didn't block that out and do that first thing in the morning, I wouldn't finish that for the rest of the day, because once you start answering emails, answering text messages, things that you need to do, you get in that reactive state. So do a really good combination of focus, watch your metrics that are important, and speed of execution. The moment that you think something is a good idea and you've thought through it and you talked about it with peers that you respect, that look up to you, that want you to succeed, and they've confirmed that's a good idea, just go as fast as you can. And that speed of execution can really give you a ton of advantage over people that may be smarter than you, have a better network than you, have more access to capital than you. You can overcome a lot of weaknesses.
A lot of great habits there. And I mean, listening to Hunter share a bunch of his habits with us, the key is really doing that research, knowing your niche very well, but also that ability to take so much action. Have action as your automatic, that default choice where if it's between taking action and waiting, you're automatically taking action. And that's something that a lot of really successful people have in common. Another thing that I feel like a lot of them have in common is this desire to learn. You're doing a great job of that right now, listening to Breakthrough Success, listening to this episode. Another great way to learn is to read as many books as you can. So with that in mind, Hunter, I'm wondering if you could share with us 3 books that you believe would have a positive impact on us.
Absolutely. So, I'm sure you've gotten a lot of the same suggestions because there's so many heavy hitters out there, but I'll give a couple that I think don't get talked about enough. Number 1 is Double Double by Cameron Herold. Cameron Harrell is probably one of the most influential people when it comes to entrepreneurship in my life. I don't know him personally. We've exchanged emails. He's been a guest on my podcast. But other than that, this book is basically a very dense operating manual of how to be an entrepreneur and how to double your business in 3 years. And if you execute this, you're going to, again, see some tremendous results. He was also the co-author of Miracle Mornings for Entrepreneurs, which I also really like. Another one is Deep Work. Now, that one does get a little bit of recognition, but again, I want to make sure people understand this. When it comes to time blocks, doing things that are cognitively demanding in long blocks of time without interruption, Deep Work is a really good model for that. And I also will say that the charisma myth is another one that I think doesn't get nearly enough recognition. That is awesome. This is basically debunking the myth that you cannot learn to be charismatic. There is certainly the case that certain people are born with overwhelming amounts of charisma, and it makes their life a lot easier. No one's denying that. But the myth is that you can't learn these things, or you can't significantly help the amount of charisma that you have. And that skill can help you tremendously in sales or being able to move up or just the friendships that you have. I'll give you a perfect example. I do a lot of my networking is done over the internet. Like I mentioned, I'm a host of a podcast. A lot of my interactions with my clients are via email or phone call or through the podcast. And so when I do in-person meetings, there's this level of uncomfortableness that I have found personally that every now and then something weird happens. You have an uncomfortable moment, whether it be related to the conversation or just external factors. So if you're in a restaurant and it takes really long to get the check, or if it's really hot, or if the conversation kind of dies and you don't know what to do and you have that nervous look on your face, the person who you're talking to, they pick up on your nervous look and they always assume it's about them. And that's not, it's almost never the case. And so if you can just do something to avoid that nervous look, and a great way to do this is whenever you feel that nervousness, whether it's about how hot the temperature is in the restaurant or some awkward moment that you just had or some awkward moment that you thought about from 3 months ago, if you just take a second to think about something really nice that you really like about the person you're meeting with, that nervous look is completely replaced with like refreshingness, and the person you're with instantly recognizes that and also assumes it's about them. That little tip that I just dropped is helped me so much for years. So if you are interested in stuff like that, the charisma myth is a good one.
Hunter, thank you for sharing with us those great books. All of those will be in the show notes, markguberti.com/E213. We will also throw in content marketing secrets in there for people looking to get more traffic, boost more revenue. That book has that kind of info for you if you're trying to do that with your content. And before we wrap up this episode, Hunter, I've asked you several questions throughout our time together, but what do you believe is one question that we need to be asking ourselves more often?
That's a good one. You kind of caught me off guard. I'm going to have to say it's really, what is the skill that I have been sitting on that I haven't used to the nth degree? Because everyone is an expert in something. And I know that there's just more production that can be taking place right now. And so that's what I would be motivating people to do, is to consider what skill set they've been sitting on. Even if it's something, I know that a lot of listeners have jobs and are looking for a side hustle or have a side hustle. There is no better time in the history of the world to have some cool side hustle. Here's exactly how it works. You have an expertise in a certain thing. You write an ebook about it that's 10,000 words. You create a landing page. You get people's email address in exchange for the ebook. Boom. You started your first online business. That right there is basically a zero cost type of situation. It's a PDF, not a real book. And maybe it would take you a month to write. I am a huge proponent of ebooks, and I know you've written a lot of them and books themselves. So just take that expertise and put it down on paper. And putting it down on paper is going to help you even be more of an expert. So yeah, that's one of the questions I think that people should be asking themselves more.
Hunter, thank you so much for taking the time to share all of your great insights with us. For anyone who wants to learn more about him, just head over to Cashflow Connections. He's got the website. He also has the podcast as well. Both of those will be in the show notes. But again, Hunter, I can't thank you enough for sharing all of your great insights with us. It was such a pleasure to have you on Breakthrough Success.
Yeah, I really appreciate it. And for anyone that wants to learn more about self-storage specifically, just shoot me an email at info@cashflowconnections.com and we'll send you that free ebook immediately.
All right, perfect. We will include that in the show notes as well. Feel free to email Hunter if you want your copy.
Thanks again.
That's it.
Awesome. Dude, we covered so much content there.
Yeah, I'm really happy. I mean, you went all out. You gave us a really great episode.
Awesome. Yeah, great to hear. And don't hesitate to shoot it over to me once it's live, and we'll have my assistant will share it with all our socials.
Awesome. I mean, I have the date, February 22nd, but I will send you an email to let you give you the official link and stuff.
Okay, perfect. We'll do it.
So, I mean, again, thank you so much for coming on the show. I know you are in California, so you are still in the AM. Am I right on that?
Yeah, that's right. 11:15 right now.
I've got a big 2 on my screen, but time is relative. And
Agreed. Well, yeah, I can't thank you enough. Shoot me that email once it's live, and we'll do it again in a couple months.
Definitely.
All right, have a good one.
You too. Take care, Hunter. Want to dominate the podcasting industry? Now you can with your free copy of my book, Podcast Domination. You'll learn how to launch, grow, and monetize your very own show. And whether you are a beginner or an expert, this book has a lot of golden nuggets for you. We'll cover the cost of producing this book. All we ask is that you cover the shipping. To get your copy, head over to markguberti.com/PD.